In this lesson, we will compare municipal bonds to taxable corporate bonds using after-tax returns, explain the break-even tax rate, and then analyze a capital gains timing decision for a stock sale. Problem 1. Dennis is comparing municipal bonds, which pay 8.55%, and are typically tax-exempt, with taxable corporate bonds from Coca-Cola that pay 11.40%. To compare fairly, we convert the taxable bond to an after-tax yield using the formula after-tax yield equals nominal yield times 1 minus t, where t is the marginal tax rate. Case A. If Dennis is in the 22% bracket, the after-tax yield on the taxable bond is 11.40% times 0.78, which equals 8.892%. Let's compare that to the municipal yield of 8.55%. Since 8.892% is greater than 8.55%, the taxable bond wins at a 22% tax rate. Case B. If Dennis is in the 32% bracket, the after-tax yield becomes 11.40% times 0.68, which equals 7.752%. Now compare to the municipal bond. 7.752% is now less than 8.55%. So the municipal bond wins at a 32% tax rate. Case C. To find the break-even tax rate, set the taxable after-tax yield equal to the municipal yield. That is 11.40% times 1 minus t equals 8.55%. Solve for 1 minus t equals 0.75. So t equals 0.25. That is 25%. Case D. What strategy is this decision based on? We are comparing after-tax returns to choose the higher one, which is an income-shifting strategy. Among the listed choices, the correct answer is income-shifting strategy. Problem 2. Helen owns 900 shares purchased 11 months ago, and each share has increased by $50. Her total unrealized gain is $45,000. If sold now, after 11 months, the gain is short-term, taxed at her marginal rate of 25%. If she waits one more month, the gain becomes long-term and is taxed at 15%. We will ignore time value of money. Visually, here is a simple timeline from 11 months to 1 year. And here is the tax picture, the same $45,000 of gain, but the tax slice is larger if sold now at 25%, and smaller if sold after 1 year at 15%. Let us compute the tax dollars for each case. If sold now, tax equals 45,000 times 0.25, which is $11,250. If sold after 1 more month, tax equals 45,000 times 0.15, which is $6,750. The tax savings from waiting 1 more month is $4,500. What might prevent waiting? Price risk due to market volatility, a lockup or trading restriction, or the need for immediate cash for liquidity. Summary. For bonds, compare after-tax yields and choose the higher one. Break-even here occurs at a 25% tax rate. For capital gains, timing the sale to qualify for long-term treatment can reduce taxes, but the decision must weigh market risk and personal constraints.